Welcome to our Voices of Africa podcast, brought to you by Africa Practice, a strategic advisory firm supplying insights and advocacy solutions to corporations, investors, governments, and foundations in Africa. In a world with complex and interdependent challenges, we take the guesswork out of business engagement. We enable our clients to see more clearly in order to drive sustainable and equitable development.
Hello and welcome to Voices of Africa. Today we're going to be talking about the cost of capital, specifically the amount of interest that we pay to borrow money. The rate of interest, as many of you know, is influenced by a complex web of conditions and dependencies. They're not easy to understand, but I hope in the course of this episode that we're going to distill these for you. We're certainly going to have a good crack at trying to do exactly that. It's a subject, the cost of capital, that may feel abstract to many of our listeners, but it's a subject that we should all understand because it affects us all. Everything from the price of electricity that we pay to the affordability of our mortgages, and even to the ability of our economies to grow at the pace that we need to defeat poverty and deliver prosperity on the African continent. Today, we're fortunate to have none other than Tshabalala, CEO of Standard Bank, to help us talk through this subject. Welcome, Sim. Thanks so much for joining us.
Thank you, Marcus. What a privilege, and I've been looking forward to this conversation with considerable relish. So thank you very much for having me.
Well, me too. So you've had a long tenure now at Standard Bank as the CEO. It's given you a really unique vantage point from which to observe the realities of risk, observe and manage flows of capital to the continent, across the continent, and levers for change. In the last month, I've noticed that you've been more and more outspoken in diagnosing the problem around the high cost of capital for African borrowers. And I know that you've been very active recently in preparing for the G20 summit in November, in advancing recommendations and initiatives as part of your chairmanship of the Finance and Infrastructure Task Force for the B20, but also in your capacity as a member of the World Bank Private Sector Labs. And we want to get into those recommendations and initiatives during the course of this conversation. But before we do, perhaps I could ask you to spell out for us, as simply as possible, why it is that African governments face significantly higher borrowing costs than their counterparts in wealthier nations. Why does this disparity exist?
Well, Marcus, thank you very, very much. And perhaps I want to do justice and honor to your audience and start with the theory, because I think it actually is important to try and talk about it. And you'll hold me to account during the course of the conversation where things get too technical, and we'll try and simplify it. But borrowing costs, clearly you start by describing them as the interest rate. And that's where you need to start in the analysis. And you can think of these interest rates as being built in layers. The first layer, you start with the risk-free rate, which is usually the rate that the United States government pays, or the German, where the German government pays, where lenders believe that the chances of default are as close to 100% as is practical. So that's your first layer. Your next layer is obviously then based on the risk. The country risk would be the cost that the sovereign would pay. And we'll come back then to the sovereign, the cost of what the government pays. The next layer would be the cost that a developed market corporate company would pay, and or a state-owned entity. The next layer would be what wealthy individuals would pay. Then the next layer is going to be what an ordinary person buying a home or a vehicle would pay. And then on top of that would be what an ordinary person buying consumer goods on an unsecured loan would pay. And then on top of that would be the cost then that all those individuals would pay if they are coming from emerging markets. So then there are many, many layers. An important determinant, though, of what that sovereign would pay, which then determines what somebody in Kenya or Nigeria or South Africa would pay, is how the ratings agencies rate that country. And they use quantitative methods. So they determine the GDP, the size of the economy. They determine the debt of the country and the ability of that country to repay its debts. They look at the size of the informal economy. They look at how the country collects its taxes, and they allocate then a rating to it, to a particular country. In addition to that, they apply evaluative methods. They look at judgmental calls about the quality of governance in a particular country. And in that respect, they would usually use World Bank governance indicators, for example, to determine those factors. They will then allocate that rating, double B minus in the case of South Africa, which is below investment grade. Investment grade would be triple B in that instance, and that determines the ability and likelihood of the country to meet its obligations as they fall due. And depending on the rung a particular country is on, that rung determines the cost of that borrowing. And so let's look at Angola, for example. Angola has got a sub-investment grade rating. They will pay 707 basis points on top of what the US government pays. Take South Africa, which also is at the moment sub-investment grade. They will pay 293 basis points. In addition to all of that, Marcus, there are internal dynamics in a country which determine what a commercial borrower would pay. And so let's use Angola again. The policy rate, which is the rate determined by the central bank to manage inflation in the country, is 19.5%. The commercial borrower would pay 20%, whereas the consumer would pay 25%. In South Africa, same analysis, the policy rate is 7.25%. That's what the country uses to manage inflation by the central bank. Consumer lending in South Africa is 15%. Commercial lending is 10.75%. And therefore, in each case, factors that relate to inflation, what happens in the country, and importantly, what happens with how the ratings agencies rate the country determine what you pay. However, and I'll stop at this point and just hand it back to you, the allocation of those ratings by ratings agencies are challengeable, because the criticism many of us have advanced of the ratings agencies is that they don't know enough about the countries that they rate, with a consequence that people add buffers on the rating, which is costly. So take South Africa as an example. South Africa, as I said, is rated double B minus. On our analysis, South Africa should be rated triple B, in which case that cost of 293 basis points I was referring to should be significantly less if it was at triple B. The ratings agencies have responded, and we can come back to that a bit later, but there's more to be done. They've responded, for example, in the case of Moody's, by purchasing a local and African rating agency so that they've got greater local knowledge. S&P has done the same. They've increased their resources in Africa, in South Africa, in Johannesburg, with a view to improving their knowledge of the country. But the proposition is that there's a significant premium being paid by African sovereigns over and above what they should be paying because the ratings are misaligned with the fundamentals. Let me stop there. I hope that hangs together.
It's very helpful. I recall reading analysis that I think was done by UNDP, which spelled out that over a defined period, in their assessment, a fairer credit rating, and that's what you're pointing us to, could have saved African nations to the tune of $75 billion. I mean, these are staggering sums of money that are left, as you say, to discretion in some respects. You mentioned that your own assessment and analysis places South Africa, I think it was, in the case that you gave, at a different rating to the ones that the agencies have themselves assigned to South Africa. And this costs billions of dollars. I think I remember reading in some analysis as well the example of Côte d'Ivoire when it issued a Eurobond last year, a similar credit rating to or risk rating to a non-African country, but the cost of its borrowing was significantly higher than would have been for the counterparty outside of for the comparator country outside of Africa. And it's this prejudice, I think, something that we referred to at Africa Practice in the study that we did last year, is really a prejudice premium that is a tax that African sovereigns pay to access debt capital markets. That is, to my mind, it's unfair, it's not justifiable. But we've got to do our homework on the continent to make sure that we prosecute that case with the evidence and the data to address it. There's a human cost of this, of course, as well, isn't there? We're talking here about finance at a sovereign level and the big figures there. But it affects small and medium-sized enterprises. It affects households on a daily basis. You compare interest rates offered to SMEs, by way of example, on the continent, between 15-30% in some cases. You compare those with their peers in Europe, hovering around 4 or 8%. Mortgages also. It's very hard for African households to build intergenerational wealth if they can't access debt at affordable prices. And that's the heart of the issue. You see it playing out in your banking business all across the continent. You're operating in 20 countries. I wonder if you could point out some of the lost opportunity that you observe as a consequence of these really prohibitive rates of interest that make accessing capital unaffordable to so much of the continent.
Oh, absolutely, Marcus. So I made reference to Angola and South Africa, and let's mention a couple more. Ethiopia, no, let's not use Ethiopia. Let's use Cote d'Ivoire that you made reference to. Their sovereign spread is 405 basis points. However, the policy rate in the Ivory Coast is 3.25% because inflation is so low relative to other markets. Consumer lending, however, is 10%. Commercial lending is 6%. So there's a big spread as a consequence of this misalignment. And like you say, in African countries face lots of challenges in accessing capital markets at appropriate pricing levels because they face many, many challenges that relate to their debt sustainability, their fiscal deficits, and the geopolitical instability. And so many of the things are beyond the control of these countries, but many are, and we'll come back to the ones that are within their control and what needs to be done. But this has knock-on effects. They've got real economy impacts, and let's humanize it. So a family in Kenya, like you say, faces mortgage rates of between 15% and over 21%. And like you correctly point out, versus the United Kingdom family that can get a mortgage at 5.1%. And by the way, again, like you allude, this doesn't reflect inflation differentials. The gap is just inexplicable. At the moment, as you know, the inflation rate in Kenya is 4.1%, whereas that in the United Kingdom is 3.6%. So the difference is just hard to understand. It makes home ownership and building generational wealth impossible. It makes it well nigh impossible. And these high costs are as a consequence of this risk premium, manifest in the credit ratings, but also manifest in what risk managers in asset management companies, in pension funds, and indeed in banks and insurance companies add as a consequence. Just looking at South Africa, Marcus, just to go back to the point that you were making, if South Africa was ranked and rated triple B, as we think it should, based on our own analysis. What's the analysis? The analysis is what is the observed default rate of countries that are similar to South Africa versus the rating that the agencies have given us. The mismatch is just too big to be explained by the fundamentals. In the case of South Africa, we're saying it should be closer to triple B. If South Africa was a triple B, South Africa would save close to 50 billion rand per annum on interest costs. Now, that's just South Africa. Again, just in support of your proposition relative to countries on the African continent. And as far as the ratings agencies go, what needs to be done? What have we been arguing for? We've been arguing that they need to have more people that understand the continent. And as I say, they've started to respond. Credit to them. In the case of Moody's and S&P, what should the countries be doing? They need to improve the quality of their investor relations, a bit like we do in business. Make sure that you understand what your investors require of you, and make sure that you start to make your investment case in as professional a way as you can. And if I may use a practical example, I was in Marrakesh a couple of years ago, and the Ministry of Finance and the Central Bank of Kenya presented their case to the investment community, crystal clear. They described what they would be doing on the fiscal side. They described what they were doing in the monetary space. And lo and behold, between now and that time, the sovereign spread in Kenya improved as a consequence of good communications and good explanation of what is going on. The second and the third things that ought to be done are a little bit harder. It's the countries need to increase the quality of monetary policy execution. And here you need a credible central bank, as well as making sure that the exchange rate reflects economic fundamentals, which implies that it should be floating. And then thirdly, they need to have budget transparency, publish the details of everything that is owed and of all the tax that is collected. Just to go back to the ratings agencies, I was making the case that the World Bank governance indicators need to be more up to date, because just think about South Africa, for example. South Africa is in the bottom 20% of countries and is rated very, very similarly to Eritrea. How can that be? It just doesn't match the fundamentals of what is happening on the ground. And yet these governance indicators make up a large proportion of the analysis by the ratings agencies. But I do think, just to complete the point, there is some movement happening with the ratings agencies, and it is our earnest hope that the countries do the same. And the conversation we will be having with you in the next few days, hopefully will take that conversation a little bit further.
So for our audience's benefit, we're co-hosting a conference next week in Johannesburg, Financing Africa Forward, the Cost of Capital. We're bringing together stakeholders from across the spectrum, from multilateral development banks, from commercial businesses, financial services providers like Standard Bank, like your peers, and credit ratings agencies themselves, academics, think tanks. And we're doing so in partnership with the One Campaign and the African Peer Review Mechanism, really to hash out a blueprint for concerted action that can be taken by lenders, and by agencies, by borrowers, by all of us, to address this high cost of capital. We've got to bring down these stubbornly high rates of interest so that Africa can finance its development. We know that we face dramatically dwindling aid to the continent. We know that we've got to generate revenue from, both from outside the continent, but from within the continent as well, put more African capital to play within the continent. And I want to turn now to the work that you've been leading as chair of the B20 Finance and Infrastructure Task Force, and your work as a member of the World Bank Private Sector Investment Lab. I know that you've been pushing recommendations through both those platforms. I wonder if you can speak to us about those recommendations, perhaps one or two that you think can really be very catalytic in addressing this thorny obstacle to Africa's growth and development. You've talked about investor relations. You've talked about the importance of strong and coherent monetary policy. But I wonder if there are some specific recommendations that will be coming out of the task force that you've been working on with the World Bank.
Yes. So, I mean, Marcus, the continent needs $170 billion per annum from 2025 onwards for infrastructure, electricity, transmission lines, generation, distribution, roads, ports, bridges, dams, cement factories, kilns, data centers, and so forth. And yet we can only raise $85 billion. So we've got a gap of 85. And where's this $85 billion going to come from? And that is the nub of the issue that we face in that task force. And we're going to address it in two pillars, if I could mention two pillars for this purpose. The first one is to say, What we need to do is we need to get other people into these projects who are able to take greater risk, what financiers would call first loss risk, and thereby make these projects more investable and therefore stimulate the pension funds, the insurance companies, the banks, and other financiers on the continent. So that's the first big one. And how do you do this? You do it by de-risking these projects by using more concessional finance, finding people that are happy to take greater risk, and they do exist, in the nature of public, private, and philanthropic entities that identify the risks akin to the people that are providing them with that finance. So using this blended finance in these structures would then crowd in, as I say, more private capital, and that is really essential for closing that $85 billion gap that I was referring to. The second set of ideas in this pillar is try and mobilize capital through the multilateral development banks and the development finance institutions by making sure that their mandates better leverage their capital base. So, for example, they shouldn't be competing with commercial banks. They should have mandates that are consistent with the development mandates that they have. And therefore, the mandates should be made much more clearer. For example, in the case of the World Bank, that they should not be crowding out private capital. Make sure that we are crowding in more philanthropies, the global philanthropies. And the example that you used of the World Bank Private Sector Investment Lab is great, because that has put in place a number of reforms that the World Bank is actually currently executing, which are adding tremendous value. So, for example, the first of these recommendations was to say the World Bank now needs to provide guarantees to countries that are double B minus. South Africa, for example. At the moment, or prior to this, they couldn't. If they are able to provide double B minus guarantees, they crowd in more financial institutions by doing so. The second one is for them to recycle their capital. In other words, if they've lent money to somebody, sell the loan to commercial banks, release the capital, and advance another loan. That's the second thing that they've been encouraged to do. And the third one is the M300 program, where 12 African countries have signed national energy compacts that signal their commitment to regulatory reform that attracts investment into energy programs. It's a fantastic idea. It helps with improving the regulatory environment, improving the procurement processes, improving the contracting, and then empowering countries to be able to do this. The second set of recommendations revolves around changing the prudential requirements that will help to mobilize private capital for infrastructure. So, for example, the current capital requirements on banks impose a disproportionately high risk on projects, and yet we know that these projects are close to investment grade. So, for regulatory purposes, we end up holding more capital than we should. What we are arguing for is that Basel and the regulations ought to be changed to align the risk-weighted allocations, the amount of capital that is then held against these projects, and make it more aligned to the actual riskiness of these projects, which would release a huge amount of capital. The third one is to do the same, to change the risk weighting associated with multilateral development banks and development finance institutions and make that zero, because they are actually as safe as houses. That would also then make it easier for commercial banks to take risk on them, and that will then stimulate more financing into these projects. All of this is calculated to make it more effective for domestic financial institutions, such as pension funds, banks, asset managers, and insurance companies to get involved in these projects, and would also make it easier for international money that is looking to invest in African projects, make it easier for them to enter. You were going to ask me a question, I think, about risk weights.
Sorry, I was. It's on the second point you made, but it relates to the third as well. If I've understood this correctly, I mean we have two countries of investment grade on the continent, Botswana and Mauritius.
Botswana and
Um,
Mauritius, yes.
yeah. So every other country is sub-investment grade. I think if I've understood correctly, what that means is that a strong project seeking funding in that country is frankly compromised by its host country rating from accessing affordable capital. And moreover, in the way that you presented it, is actually your ability to participate in that project is compromised because of the amount of capital that you have to hold. I think it's the capital adequacy requirement that you have to hold in order to be exposed to that risk. Perhaps you could confirm or elaborate that point in language that's a bit clearer than I've been able to do.
Precisely so. So anybody wanting to invest in South Africa is going to look at the ratings of South Africa. It's double B minus. A double B minus country attracts a particular rating. In the case of South Africa, it's 293 basis points. It's actually higher than what it should be based on the South African fundamentals. So that's the first one. The second one is that for regulatory purposes in South Africa, if Standard Bank is going to invest in an electrification project, for example, it needs to designate that for regulatory purposes as specialized lending. And it needs to analyze that lending and assign a rating to it of between 100 and 150 basis points for risk-weighted purposes. So it means at 100%, a project that is going to cost us 100 million rand, 100% is 100 million rand multiplied by our capital adequacy, which is 12.5%, which means we need to hold capital of 12.5%. If the rating was risk-weighted at 50%, we would therefore hold half of the capital that we would be holding for this project. So in other words, if the risk weights were more accurate and more akin to what the project's riskiness actually is, we would end up holding less capital, and therefore we could lend more to these projects. We could lend a larger number. And so we're arguing that the authorities need to rewrite the rules to make it easier for us to invest in these projects by reducing the amount of capital that we hold. So if you reduce the amount of capital that we hold, we can lend more into the projects. So 100% correct.
It's a perverse state of affairs, isn't it, when Africa's leading financial institution, private sector financial institution, can't invest in the projects that it sees, that it wants to and sees opportunity in on its own continent.
And all that needs to happen is a diminution of the risk-weighted assets and therefore a diminution of the capital held, which would release more in the nature of lending into the projects. Precisely so.
So it all starts with these risk ratings.
Yep.
I don't know if you saw, but I penned an article in Business Day. It was a letter, in fact, a few weeks ago in response to an interview that you'd granted. We've not spoken between the publication of that, but I was trying to draw an analogy of this situation to try and simplify it for audiences. And the analogy I drew is that if growth and development is a mountain to climb, then far from everyone being equal, some nations get harnesses to help them make the fast ascent, while African countries have to scale theirs with weighted vests. These weighted vests are the cripplingly high cost of borrowing money.
Yes.
Yeah.
There you go. It's a brilliant analogy, and it's spot on.
The problem is, of course, there's no single cause or culprit. It's a complex interplay of conditions, and we need to work at all facets of that interplay, as you say, right from the apex of the global level, the international financial architecture, the IMF, the World Bank, and the credit ratings agencies themselves, and all the other different actors, including African sovereigns, and the requirement for them to frankly up their game in terms of their investor relations, provide more data, more transparency, and a more compelling narrative. I think it is absolutely evidently the case that the data that is furnished to date by most African sovereigns doesn't paint the full picture. We know that there's more dynamism happening on the continent than is reflected in the data that is presented. An institution like yours sees it every day because you're banking customers from small and medium enterprises to startups and big multinationals and everything in between. So when our audience hears from someone like you that you want to put more capital to play on the continent, but you're constrained from doing so, it's a wake-up call that something has to change. As you say, we have to rewrite the rules. So assuming
And
we
Marcus,
can rewrite, yeah, sorry,
Marcus,
yeah,
if I may just jump
yeah,
in, that's precisely what we've been arguing for in the finance and infrastructure
yeah,
working task force of the B20. And the set of recommendations we are putting forth cover both what, in this case, what the projects need in order for them to be more easily executable. So that's the first set of recommendations. Then the second one is how to get more resources into those projects. And then the third one is how to get the projects to trickle the financing from the project into the economy and into SMEs. And part of that has to do then with the changing of the regulations that relate to the capital that is held by financial institutions against these projects. And that's just one of the recommendations.
yeah. So turning a vicious cycle of debt, and we've heard recently from both out of the Financing for Development Conference and the Vatican Commission report about the debt situation on the African continent, turning that situation into a virtuous cycle of self-generating growth in the way that you've just inferred through changes to those rules. Assuming we can do this, assuming we can close also the $100 billion, or I think it was more, but in excess of $100 billion annual infrastructure financing gap on the continent, what does the continent's economic landscape look like to you 10 years, 15, 20 years from now?
Well, before I do that, Marcus, I want to cheat and do a bit of storytelling around how to move from that regulatory argument I was making to financial institutions, whether they be asset managers, banks, pension funds, and so forth, how they can then get involved. And what do these projects look like? And then I'll turn to what the next 10 years look like. And for me, the ultimate de-risking tool is domestic institutional investors getting involved. So that's what we want. That's what we need to stimulate. And what we want to make sure of is that local banks, like Standard Bank, become co-funders to these projects. So that's what that argument that you and I were having just now is all about. And having us involved, local pension funds, local insurance companies, local development finance institutions, give confidence to international investors to help us close that gap. And that's the argument in our thesis. And there are many ways in which we and our competitors do this. We, in our case, for instance, in 2024, we directed nearly 6 times more financing to renewable energy than to non-renewable power. So not only were we addressing the energy deficit, we were assisting the continent contribute to its own transition and doing so in a manner that was appropriate given our mandate as a Standard Bank. And that's an important thing for financial institutions to do. In 2035, Marcus, we want growth to be driven by Africa's own savings, mobilized by Africans themselves, by competitive foreign direct investment, not aid and not foreign debt. And so I echo you, and I agree entirely with you. We want to close the financing gap by pushing growth to well beyond 4% beyond 2026. The Africa Continental Free Trade Area must boost intra-Africa trade, and we know that it could add an estimated $560 billion in annual exports and $450 billion in additional income. That is a vast amount of money. But stuff needs to be done. The legal and regulatory environment necessary to deal with tariffs and so forth needs to be in place. We've got a young population, so job creation sectors need to be stimulated, and we need to improve workforce participation for Africa's young, and that could add 47 billion to annual GDP on the continent. We can become a leader in the green economy, and that's why I gave you that example of us lending 6 times more to green finance in our book than to fossil fuels. And we could capture then a significant share of the 16 trillion in global market for green minerals by locally processing and manufacturing. That's possible, and we ought to be aiming for it. And so success, Marcus, means that the entrepreneur, the government, and the family that you started with will no longer be handicapped. The tech startup gets local VC funding from local sources. The government finances hospitals with local currency bonds. The family sources an affordable mortgage. And that, for me, is true economic sovereignty.
Yeah, and it's exactly that. It's the economic sovereignty that is at the heart of the solution. Well, thank you, Sim. You've given us a really powerful and clear-eyed view at the outset of the profound challenges, but just now of the immense tangible opportunities that lie before us. You've told us that it's absolutely imperative that we move now from sort of diagnosing the problem to setting out recommendations and pursuing policies that deliver the action that we need, rewriting the rules, to paraphrase you, and those rules need to address the systemic, well, they need to address systemic de-risking. They need to include radical transparency, including from African sovereigns to support their investor relations, more provision of data, and to the latter point that you made, more confidence from Africa's own institutions in mobilizing their capital to make it work on the continent. I think that's more than just a call to action, because I know that you're doing the hard graft, not just within Standard Bank, but through the various platforms and initiatives that you're leading with others. It's great to hear someone who is as invested as you are at addressing this systemic constraint for Africa, that really does hold back the continent and affects lives and livelihoods in the way that you've said. I'm so looking forward to joining you and everyone else who will be joining us at Financing Africa Forward, where we're going to be taking some of these initiatives into the conversation with others and coming out with some clear recommendations that support the work that you've been doing with the B20. So thank you, Sim, for joining us on Voices of Africa. Thank you very much.
Thank you, Marcus, and it'll be great to continue to partner with you as we create greater prosperity on the continent. Thank you.
Thank you for tuning into a Voices of Africa podcast this week. Voices of Africa is a forum where Africa's leading experts weigh in on cross-sectional topics affecting the continent. Experts share their views on how we can unlock greater value that will benefit industry, government, and communities. For more of our insights, visit our website or subscribe to our weekly newsletter, Views on Africa, in the description.